we talk about coal to gas substitution so much when it comes to Europe, when it comes to the US. But in Asia, this has barely started to happen. So I think there's still a huge potential for that switching going forward. I think it can be a very effective way of cutting back emissions. When you generate power using gas, you emit less than half of the carbon emissions that you do when you generate power with coal.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing you better benchmarks, better technology, and better tools for risk management.
Welcome back to the Future of Energy on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Samantha Dart, Head of Natural Gas Research at Goldman Sachs. We'll be discussing the outlook for LNG and the global natural gas market and their role in the future of energy. Hello, Sam. Welcome back to Smarter Markets.
Thanks, Dave. Good to be back.
Well, it's great to have you here. I'm very thankful to have you back on to talk about LNG and the global natural gas market. And I was looking back over our conversations these past couple of years, and it seems clear that the European energy crisis and the Russian invasion of Ukraine was a watershed moment for the natural gas market. And reading your recent research at Goldman Sachs, it also seems clear that we're still dealing with the repercussions of those events. The energy crisis led to investment in more production and a new wave of LNG supply on the horizon. But before it gets here, as you said, there's a market that's still vulnerable given the shortfall of Russian natural gas. And I wanted to ask you, how much of what you're seeing in the natural gas market today is still a response to the events set in motion by the European energy crisis?
Yeah, I think that's been mainly the case if you look across Europe, right? So if you focus on how the high gas prices impacted electricity markets and as a result, energy bills for households left and right, there is this impact on inflation that is still waning and it's taking a long time, right? You always have such a long lag between how your wholesale market trades to how those prices are then translated into retail energy bills. So that's still ongoing. It's much better than it was in the 22-23 winter, but I think it still has some ways to go down. And I think the way that we see it the most across Europe is with industrial activity that is still depressed, especially across the energy intensive sectors. And to be fair, that's not just a natural gas price issue that was the trigger initially, but that was then followed by a macro issue. The fact that when you looked at inventories of finished goods across the economy, hey, we got enough. No need to really produce anymore. So we've been going through this destocking process, arguably behind us now. But I think when you look across industrial users of gas and power, and you talk to them about confidence in downstream demand, confidence in growth, that confidence is just not quite there yet. So we see a market in Europe that is still somewhat traumatized by what happened. There have been some other changes elsewhere in the world as well. I think the way that different regions learn to not just look at gas markets, but how they trade it. So, for example, we had countries like Pakistan come out and say, hey, this is way too much volatility for me to rely on natural gas as a fuel for the future. So they actually changed their policy to maybe go back to coal a little bit more. If you look at how China faced that moment, they didn't particularly need the gas when gas prices were skyrocketing. So they took the opportunity to just resell a lot of their pre-contracted volumes back in the market. That was a big change because we used to look at China contracted volumes, the majority of contracted volumes for that matter, as sort of a good predictor of how much these countries would import of LNG. And it's just not the case anymore. So the way that folks look at this market, I think, has changed as well.
And when you look out over the next few years, I read your research where you're seeing a wave of LNG projects coming on and a wave of supply over the next few years. How big a wave do you see coming, and where's it coming from?
It's massive, right? So if you think about the size of the market today, we're talking about upcoming capacity additions equivalent to about 50% of the size of the current market. But I think the most important stat is not even that one. It's the fact that you're adding, let's say, between 2025 and 2029, you're adding about 200 million tons of LNG when your average demand growth out of Asia for LNG imports is less than 20. So it just doesn't add up, right? And it gives you a pretty good sense of what's to come. We're likely to be not just oversupplied, but extremely oversupplied. And then we think that the way to balance the market is exactly with prices falling, looking for a home, looking for new demand, new ways to absorb all that LNG. So it's difficult to avoid that type of scenario when the scale of supply growth is that large.
And what do you think's been driving all the investment in LNG export capacity?
Part of that investment happened after the crisis, or during the crisis, I should say. And to remind, natural gas prices really took off before even the Ukraine war started. If you go back to really the spring of 2021, that's when we had a big weather event in Europe that triggered the process of gas becoming more expensive than coal. That happened to be a tight summer. And it was really the fall of 2021 when Russia started to cut spot sales to Europe. That was the straw that broke the camel's back. And then the spike in prices took really a different scale. Some projects did reach FID after that happened, but a lot of other projects that are coming online over the next few years, they have been under construction for quite a few years. Some of them were FID back in 18, a lot of them in 2019. So it's cyclical nature of the investment, right? And what we expect going forward is exactly because we have this wall of LNG just about to hit us in the face. You're going to have this pressure prices lower and somewhat reduce the incentive for new investment to happen for a few years, right? So it's a wall now. It'll lead to a bear cycle in the market over the next several years, but the outcome of that should be absorbing all that glut of LNG because you're going to dry up new projects and lower prices are going to create more demand. So we live in this cyclical industry, don't we?
Yeah, we sure do. And when you kind of step away from the supply side to look at the demand side, how do you see global natural gas demand developing? There's been replacement of Russian natural gas, displacement of coal fired power generation. Where do you see demand for natural gas growing, if at all?
I think different regions will behave very differently here. So when we look at Europe and what they had to go through, and let's be very clear, there has not been a replacement of Russian gas with other supply in Europe. LNG imports haven't even come close to offsetting the loss of that gas. So what has happened is a loss of demand so that you could balance the market. You lost a lot of supply, you have no choice but to destroy demand. And even as Europe starts to recover from that process, even as European industrial activity recovers from that process, and to be clear, this is something we do believe in. And by the way, it has already started to happen. Industrial activity is starting to rebound. We see it also in the high frequency data. We see how much gas they use every day. So we can see the improvement. It's just that when it's all said and done, even when that recovery is fully done, number one, they are not likely to go back to pre-crisis consumption levels of natural gas. But number two, as you continue to add renewable generation capacity, Europe is likely to be a declining consumer of natural gas globally. And that's very different from what we expect to see in Asia. I think Asia not only is the opposite direction, it's a growing center of gas consumption. It's, I think, accelerating over time. And the main reason for that is not just the natural sort of coal to gas substitution push that we've seen, but also the fact that if we're right and we see these few years of lower gas prices because of the amount of LNG supply coming, having low gas prices for several years in a row can help create further infrastructure to absorb all that gas, right? Can help in the same way I mentioned Pakistan earlier, shifting their strategy to rely more on coal going forward. We can expect a potential reversal of that. We can expect other countries in Asia in investing more and more in infrastructure to consume that natural gas. So I think low prices will end up fixing low prices by creating enough demand growth in Asia to way more than offset the losses that we're likely to see from Europe over the next several years.
I want to come back to that point with you, but first, you mentioned the decline in European industrial activity given the shortfall of the gas that really drove it. And I wanted to know, like, have you seen that industrial activity migrate to other places in the world? Or is that more of a net loss? Like, did the activity go to the gas and the power sources, or did we just lose it?
There was definitely some migration, and some companies more vocal about it than others. But a lot of industrial users of gas and power that we talk to on a regular basis, they were very explicit about, hey, we're going to go to the US. The US has the Inflation Reduction Act offering a lot of incentives for us to decarbonize. We might as well do it there. A few companies mentioned moving to China as well, but not quite as many as the ones that talked about the US as the destination of choice for their investment. But there is also another way in which we see this deindustrialization of Europe unfolding. And it's the fact that China itself is growing its own production capacity. So when you think about petrochemical production or automotive production, you have a growth in those sectors in China that ultimately reduce how much Europe ends up exporting of those industrial products to China, right? So I think this is part of the reason why, when it's all said and done and things are quote unquote normalized in Europe, industrial activity is not likely to go back to what it was.
And I wanted to go back to ask you about demand in Asia and really some of the developing countries. Are you seeing more of a role for natural gas, more infrastructure, even more interest in natural gas from some of the developing countries in the global south?
In some instances, it's just lack of alternative, right? So countries that used to rely on their own feed gas or the feed gas from neighboring countries, and that production of gas is just disappearing. Egypt is a good, very recent example of that. Egypt had stopped importing LNG several years ago, just about 6 years ago, because they were producing more, importing more from Israel, and just able to become an outright exporter of LNG. This is now reversed again. Egypt was not able to export any LNG last summer. This summer, they're going through the same issue, and now they are just in the process, as we speak, of installing an import facility back, right? So you have sometimes no alternative. You have the loss of gas supply, and then you have to import more, and that's how you're going to grow. It's not the case for everybody, though. So if you look at China, for example, India is similar. There is a very clear strategy to rely on coal for power generation growth going forward. So when we talk about coal to gas substitution, we are really not talking that much about those two countries in particular, because they want to make that strategic decision of relying on what they have, what they can produce. China and India both do import coal as well, but the percentage of that imported coal that covers their own consumption is much smaller than the importance of imported LNG, right? So there is a very clear strategy in relying on the fuels they have, what they can produce to grow from here. I think other regions are really relying on gas for growing power generation demand going forward. That's one of the main drivers of gas consumption elsewhere in Asia. For India and China, I think really industrial demand for gas ends up being your main driver there. But elsewhere in Asia, power generation really has been the big push behind this growing consumption of gas.
And I wanted to ask you about power generation demand in the United States. Artificial intelligence has been the focus of many, many conversations over the past year. And of course, that has very large power needs. And I was curious if, are you seeing the widespread use of large language models affecting power demand in the US already? And what impact do you see it having on natural gas demand from the power sector in coming years?
When you look at commercial demand for power in particular, that's the sector where it really shows. And you look across different states in the US, Virginia is really the one location. It's sort of the birth of the data center trend. And by the way, it started even before AI, right? It really started to take off with cryptocurrency demand for power generation as well. So this has been a continuation of this growth of power demand for commercial purposes for data centers, very visible in Virginia, I think a lot more so than in other states in the US. But when we hear from utilities, when we hear from technology companies, there is now a push to diversify away from the area. Virginia is now pretty taken, not a lot of room left. So we definitely see more interest. They are looking, okay, what is the next best position? Where should we go? Where can we access either the power directly or the gas, right? If you want to build a data center and you're willing to just build your generator yourself, then you need at least the fuel. So where's the gas? Where can I get the gas? There's definitely a lot of interest in building that. That said, I think it's just interesting when we look at the scale of potential demand growth for power in the US. And we take into account, how renewable capacity is going to grow in the meantime, how coal generation capacity is going to retire in that period. What does this really mean for natural gas demand? And don't get me wrong, it is higher. We estimate it'll be significantly higher between now and the end of the decade for power generation demand. But when you compare this annual increase in gas demand driven by power to the potential production growth annually, it's no match. It's too easy for production to reach those targets. So when I think of the potential impact on natural gas prices in the US, I have a hard time building a really bull case for gas on the back of the power story.
And the production you're talking about is production within the United States?
Yeah, that's correct.
It's been such a change. We had Daniel Yergin on the podcast last week, and he highlighted that US LNG exports went from basically zero in 2016 to now leading exporter. And we've seen such a amazing increase in, more or less energy independence in the United States and everything that's meant in the world. And I wanted to ask you, when you look at the capacity of the US to continue to grow its natural gas production, it sounds like you're pretty bullish on the ability to continue that growth. Is that right?
It is. I think there's always the question, right? At what price do you get growth to show up? Gas does get the help from associated gas, right? The gas that you can produce just because you're producing oil and it's a byproduct. But you're right. At the margin, we still expect to have to rely on those pure gas basins. And each basin doesn't last forever, right? So that's a relevant point for sure. But it's not the same as saying, okay, we're going to exhaust this basin and that's it. It's just a matter of, okay, where's the next one and how much does that cost? So does that cost another 15 cents an MMBTU, another 30 cents an MMBTU? That's sort of the scale of cost increase that we're talking about more often than not. And we have to remember, US gas producers are excellent at what they do. So more often than not, they keep lowering that marginal cost over time.
Well, so we have a lot of supply on the horizon, but I've also heard you say that we still have one winter left before a lot of this LNG supply in particular arrives. And so we have a market that could still be vulnerable to upside risks. And I was wondering, could you kind of walk us through a little bit of that short-term vulnerabilities? Like, where do you see some of the biggest vulnerabilities? And do you have a particular scenario in mind that, could take us back to some of those higher prices of a couple years ago?
Yeah, I think the price levels we saw in 22 are not likely, even in the event of a tightening shock in the winter. And the reason is the levels that we got to in 22, they were that high because that's what it took to destroy that much industrial demand. Since that industrial demand has not come back in size yet, that destruction is still helping soften the balance somewhat. But yeah, when we think about not just filling storage ahead of the winter, right? A lot of the gas market, it focuses so much on that. Can we fill storage ahead of the winter? And yes, that's step one. But step two, and really the most important one, is how quickly do you draw down from those inventories during winter? And I think that's the risk to Europe today. Europe can very easily reach full storage at the end of this summer. It's not a problem at all. And it's not the question. The question is, how vulnerable is it to, say, a colder than average winter once we get to November? Can we withstand that? At this point, we don't have a buffer in supply. When you look at the amount of gas that Europe lost access to when Russia cut flows, again, this has not been met by any other substitute. It's been met by Europe reducing its heating demand, its industrial demand for gas, its power demand. None of that has come back. It's marginally better than over the past couple of years, but it hasn't come back in size. And that's what makes the system that vulnerable, because if you hit weather, demand is going to respond. There's no buffer against that, no protection against that. And what that does is it incentivizes the market to look for the next best way to offset that tightening of the balance. And since we are already pricing in line with coal generation costs in the winter, the next price threshold that could help the market balance would be oil economics. And that's about double the price of the price we see currently in the market. So we are talking about potential significant spike in prices over the winter. If we get a cold shock, we're talking about potential 100% upside. But that would take us to, say, 70 to 80 euros a megawatt hour, as opposed to the 300 plus euros a megawatt hour we saw in 22, just to give you a sense of scale here. So the risk is there, but I don't think to the levels that we saw previously.
And I wanted to ask you a little bit about how you think about weather risk right now. Going back to the European energy crisis, part of what helped, in addition to the LNG that came in, was that it was a fairly mild winter. And don't want to confuse normal weather fluctuations with climate change, but it does seem like more recently we've had milder winters in many parts of Europe and the United States, hotter summers. And I'm curious, how does that affect your thinking, or how are you thinking about the range of potential weather outcomes when you think about the winter ahead?
Yeah, and that's a tough one, right? Because we can see the change, but we still cannot guarantee, is it always going to be warmer than average then? Is that what this means? And it's not necessarily the case, right? So what we do, we typically look at a rolling 10-year average, and that rolling 10-year average gets warmer every time. So implicitly, yes, we are assuming a warmer winter than the preceding one every single time, but it's still based on the previous 10 years. And you're absolutely right. So a few months ago, we were looking at how winters had realized over the past 40 years across Asia, Europe, the US. And the data suggested that whenever you compared winter temperatures with this rolling 10-year average, in Europe in particular, winter was warmer than that average over 60% of the time. So it's not even close to 50-50 here, like Europe.
That's amazing. It's always warmer than average. And I also wanted to ask you, kind of taking a step back, because I love to hear how you're thinking about the market, not just the kind of the current outlook, kind of the process as much as the outcome. And I wanted to ask you about some other ways in which how you form your outlook may have changed over the past couple of years. As we said, we have a Europe that's now much more reliant on LNG when it used to be kind of the dumping ground if there was an excess. The United States is the top LNG exporter, and production will continue to grow, most likely. And I was curious, like, when you're thinking about putting all these pieces together, has your view of the dynamics of how the gas market works changed over the past few years?
Yeah, for sure. I would say when it comes to Europe and Asia, the main change has been that we used to look at Europe as sort of this dumping ground of whatever the rest of the world didn't want. If that meant just a little LNG, that was fine. If that meant a lot of LNG, then that's fine too. And we find a price that balanced the market that way. And what the crisis demonstrated is that there may be instances when Europe is not going to be a dumping ground. They're going to be an active player competing with Asia for those cargoes, right? So it changed the way we look at balances because now it's almost like going two rounds, two iterations. You go through what you think Asia demand looks like and what this would imply in terms of residual volumes left for Europe. But then you have to ask, well, is Europe happy with that? Because if they're not, that means you're going to be facing higher prices to compete with Asia for those volumes, right? So it definitely changed the way that we balance those two regions. I think the changes for the US have been even more dramatic in the sense that US natural gas markets were very used to seeing just gradual demand growth, a lot of that coming from power generation, industrial demand growth, nothing much and very gradual. You made a point of how the US went from 0 to 100 as an LNG exporter. And it matters a great deal because today, when you look around, it's very difficult to find another gas demand driver in the US more important than LNG. Even power, we were talking about what power can do in data centers. And yeah, it can add a little bit every year, but it still doesn't compare to a year when you happen to be starting up 2 to 3 new LNG export facilities in the US. So the US has become such a big part of the LNG cycle that whether it's today or 10 years from now, in my mind, there are two key questions to ask about the US gas market. One is how much more LNG they're exporting this year. And two is how much more production can we expect this year? That's it. Those are the two big drivers, right? So it's something that the market wasn't used to, also because it's not smooth. It depends on when these large facilities come to the market. And for example, we happen to have a year in 2025 when you have a chunk of new export capacity coming online, which means all of a sudden a big jump in demand. And in different times, you can have a couple of years like 23 and 24 when you have nothing going on and you have all that production growing and you end up with a balance that needs to see a price collapse to incentivize production to please slow down, which is exactly what we've seen for the past year and a half, right? So you end up being part of a market that looks a lot chunkier and a lot more volatile than in the past. I think volatility really is the biggest change for these markets going forward.
And do you see any short term price responsiveness from various LNG exporters? Or does the capacity go? Or is there such a thing as a marginal LNG exporter in the world today?
The operating costs at these facilities is typically so low that nobody carries spare capacity. You're either on or you're off. You have maintenance season, right? Usually those guys plan maintenance either for shoulder months or the middle of summer when they think global demand is going to be a touch lower. So you see some fluctuation in LNG supply because of maintenance schedule. But once you're out of maintenance, you're on. It's just not worth it for you to modulate that utilization rate because of how low your variable cost is. And this creates an interesting dynamic, right? Because you can have periods of time when you just have too much of that supply. And then what? Prices start to go down, go down, go down, and nobody cuts until that price is so low that starts to eat into your variable cost of production. Again, bringing a lot of swing to these prices, right? A lot of volatility. The opposite situation is also interesting because you can have a situation like the energy crisis of 22, and these installations have very limited ability to respond to it. They might delay some maintenance, other maintenance they can't even move. So it gives you some level of flex, but not much at all. To the point where, when people ask, oh, if Asia demand is really strong, is that going to pull a lot more of US LNG? Not in the near term, because you can only export the size of your capacity, and that's that. So global prices may be at $15 or 50. The US exports the capacity that it has.
So we've got a market with a lot more volatility than it has in the past. And the LNG market was historically always one with a lot of long term contracts and not many risk management tools. People would hedge their cargoes with Brent crude oil and other types of instruments. And I'm curious, you mentioned earlier China reselling cargoes into the market when prices got too high. I'm curious, are you seeing other ways in which how LNG is traded and how its price risk is managed have been changing?
A few ways. One thing I would note is during the energy crisis, because margin calls skyrocketed, like the moving price was so large that it moved out of control. So a lot of market participants faced the liquidity crisis, really. So a lot of trading has moved to over the counter tools. So just dealing directly with somebody that can help you finance your exposure or can help make a market for you, as opposed to trading directly with the exchange, because that helps you manage that exposure a bit more. This is definitely one change that happened. Another change, I would say, has been a bit of the dynamic of how these curves move. So, to give an example, since the start of the Ukraine war, about 60% of the new long term LNG contracts have been signed with US proposed facilities. So, the number of consumers of LNG today that are exposed to that price spread between US gas and European gas, or US gas and Asia gas prices, that percentage is getting larger and larger. And it impacts how the curve moves, because a lot of these guys are going to want to hedge that position. They are going to want to maybe lock in the spread between these prices and not necessarily be exposed to that spread narrowing one time or another, right? So if you have sometime a push supporting some of these global gas curves relative to the US, you end up having a lot of selling on top of that, limiting the upside, and so on and so forth. So we definitely see a lot more of these dynamics playing out in the market. And because they are more present, it's also improving liquidity farther out the curve. I remember the time when JKM was liquid 1 to 2 months forward, and that was it, right? There was nothing else. And today you see a lot of market participants, and Goldman included, we make markets out to 26, 27, and so on, right? So a few years ago, this wasn't possible.
And do you see the curves, you said they changed the way they behave. Are they moving together much more than they used to? Like, are we finally seeing really a globalizing gas market?
For Asia and Europe, definitely. Asia and Europe definitely moving together, and they should, right? Because it's a very clear arbitrage between the two regions. The US is a little bit different. I would say the US long dated price is going to help set long term global gas prices, yes, but because in natural gas, the curve is still so much influenced by what's happening in the front of the curve, the US still has some near term fundamental drivers that don't always translate into European gas price moves or Asia gas price moves. So you don't see the back ends that much correlated yet, but between Asia and Europe, very much so.
I appreciate you coming by for these conversations. It's always fantastic. I always learn a lot, and I love catching up with you. And I wanted to ask you, though, before you go, this series is really about the future of energy, and we have this globalizing natural gas market, more LNG tying these regional gas markets together into a global market. And I wanted to get your thoughts on the role of LNG and the global natural gas market in the future of energy. In particular, how do you see the role of natural gas in the global energy mix of the future?
I think we have still the potential for a significant increase of gas usage within the energy stack, especially across Asia. We talk about coal to gas substitution so much when it comes to Europe, when it comes to the US, but in Asia, this has barely started to happen. So I think there's still a huge potential for that switching going forward. I think it can be a very effective way of cutting back emissions. When you generate power using gas, you emit less than half of the carbon emissions that you do when you generate power with coal. So it makes sense to see markets moving in that direction and relying on gas until we can solve the intermittency problem. I think oftentimes we see policymakers focusing a lot on the end goal, and that's great, but I think we cannot forget the transition. How do we get there? And to make this transition affordable, you need to incentivize the availability of the fuels you need to use in the meantime. And in my view, this is what has been missing somewhat, depending on the region you look at. It's great to see renewable capacity grow, but when you still have that marginal dependency on gas, you better have that gas supply availability guaranteed, because if you don't, your energy market is still vulnerable to price spikes. I think this is what missing. We need to be a bit more pragmatic and realistic and understand that there is a transition between now and the end goal, and we would be smart to try to make it more affordable to everyone.
Thanks again to Samantha Dart, Head of Natural Gas Research at Goldman Sachs. We hope you enjoyed the episode. We'll be back next week with another episode of The Future of Energy. We hope you'll join us.
This episode was brought to you in part by Abax Exchange. Market participants need the confidence and ability to secure funding for resource development, production, processing, refining, and transportation of commodities across the globe, with markets for LNG, battery metals, and emissions offsets at the core of the transition to sustainability. Abax Exchange is building solutions to manage risk in these rapidly changing global markets, facilitating futures and options contracts designed to offer market participants clear price signals and hedging capabilities in those markets essential to our sustainable energy transition. Abax Exchange, bringing you better benchmarks, better technology, and better tools for risk management. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.